Oh,
Good morning,
so
sir.
good morning. Good morning. So can you see my screen and can I be heard properly?
Yes, sir. Yes, sir.
Okay, sure. Let me know when to
So,
start and we'll begin. Yeah.
a warm welcome to our Honorable Director, Professor Dr. Satish Ubade, our esteemed guest, Honor Mr. Rahul Dhawan, and the faculty and student of Matrix. Dear students, Matrix is committed to enhancing the management competencies of MBA graduates by expanding their knowledge through the latest developments in management. In line with this vision, our Honorable Director, Professor Dr. Satish Ubade, has initiated the 4-dimension lecture series. This series invites distinguished experts from diverse academic and industry backgrounds to share their valuable experiences, helping students enhance their knowledge and employability skills. Today, we are honored to welcome our guest of honor, Mr. Rahul Dhawan, who has an MBA in finance with over 2 decades of experience in leading financial services and IT solutions company. He holds strong expertise in equity research and financial planning. Along with his industry background, he actively conducts training workshop on personal finance and stock market analysis. Mr. Rahul also served as a mentor at several reputed educational institutes, guiding students in their intermediate and advanced level capital market courses. Please join me in warmly welcoming Mr. Rahul Dhawan.
Thank you so much for the introduction, Professor Giri, and welcome to the students of your college. Very happy to be able to address your students and your wonderful institution.
Okay,
So I hope everyone can see the slide, the presentation that
sir.
I've shared.
Before handling over to sir,
Yeah.
I request all students to turn on their cameras as we will be taking a group photograph.
Okay.
Rohit sir.
Okay. Should I proceed?
Done, sir.
Okay, thank you, Rohit sir. And once again, a warm welcome to Mr. Rahul Dhawan. Over to you, sir, for the session.
Sure. Thank you so much. So welcome to the students of your esteemed college, the Matrix. And so this is a session on financial awareness, which has been sponsored by the Sundaram Mutual Fund House. And this session is not something to teach you something, but it's basically to, lay importance of how how money can play a role in your lives. Now each of you, sitting out there is pursuing your MBA course here, and maybe in a few years, couple of years or something, all of you will be, I mean, companies would be approaching you in your campus for recruitment, or you will be reaching out to companies for jobs, and those companies are going to give you, salary in your hands, at the end of the month for the efforts that you put in, and each one will be earning that salary month on month on month. But you'll be working very hard for the money. Every time when you start out in life, you start with a lot of energy, a lot of passion, and you'll work very hard for that money that you receive every month. So it's a good thing. But if you want to build up your life constructively and you want to be able to achieve your dreams, then in fact all of your dreams, then you have to make your money work hard for you. And that journey starts right in the beginning, the moment you start working. If you are able to manage that money well, if you're able to put that in the right places, then you realize that your journey in life becomes far more easier because you're planned, you're targeted, and things work steadily, you know, not in a flurry. Like, so a lot of people who are unplanned, you see them, completely going up and down in emotions. They're targeting short-term goals, long-term goals. They never planned for it, and things don't work very well for them. So planning is extremely important, and making your money work hard for you is a key to the success. And this program, this session is basically geared towards making you aware of how you can really do that. It's not a very complicated procedure, but requires a certain amount of consistency and discipline and commitment, right? So let's begin that journey. Um, so that journey starts with the moment you receive money in your hands. Now, each one of you would be receiving some amount of money in your hands by way of maybe pocket money, which you receive from your parents to meet your, day-to-day expenses. And maybe some of you would also, so maybe some of you would also be receiving, you would receive money from some kind of an interest or vocation that you're pursuing. It's something that you're good at, some hobby or some interest in, and you are able to commercialize it and receiving some money from there. So the journey of money starts the moment you receive in your hands. Now you can choose to spend all that money, and mostly that's what we'll end up doing. The moment we receive money, we kind of spend it all, and we are seldom able to save any money. But remember this one thing, that the raw material to make more money is money itself. And this is particularly true in the case of the investment field, in the investment world. So in investment, money does not change color, it does not change form, but it is the same thing. Money creates money, and that's why it's so important that each one of you saves a certain amount of money that you receive. It could be, some percentage of what you receive. So that is where your journey starts, because this is the money that is going to create more money for you. Okay, so the raw material to make money is money itself, and that's why savings is so important. And no better than Warren Buffett. I'm sure all of you would have heard of him. Warren Buffett is the ace investor who's one of the richest people in the world and who's made all his money through investments. And at a very early age, he's probably a few years younger than you were when he started out in life. And he learned the lessons well, and he put his money in the right places. And today he's, from all the money that he had invested, like he's amongst the top 10 richest people in the world today. So we follow a lot of his mantras. His mantras are very deep, and he's like an investment guru. You've seen probably a lot of books on him, which I recommend you should read. So he says, do not save what is left after spending, but spend what is left after saving. So, because he's saying this, and this actually is true for all of us, we don't give savings any priority the moment we receive money in our hands. Even when you receive your salary or something, what people do is, okay, they first think about how I'm going to spend this money. Where am I going to, where am I going to, what am I going to achieve? What am I going to acquire? And that's the first thing that they think of. And after they've spent that money, if anything remains, if something is remained, they call it savings. So what are you doing? You're giving savings a second priority. But instead, we think the other way. The moment we receive money, a salary in our bank, if we save first, we set some money aside and put that money across, say 10%, 15%, 20%, then you are giving savings the first priority. You become more budgeted. So if you're keeping, say, 15, 20% aside, then you know that you have only 80% to spend on. So you become budgeted. You become more, guided in that sense. That, okay, you become more constricted. Okay, this is 80%, now I have to do with whatever I have right now. And so this is very important. With the remaining money is where you are going to build up a lot of wealth, because this, if you do month on month on month on month, then you realize that at some point in time you have a fund, which you can invest when you put your money into work. And that's why this savings is very, very important. But savings is not the end. It is only the beginning. Why? Because when we talk about savings, we have to figure out, where does your money really go? Is it lying in your wallet? Is it lying in your purse? Is it lying in your wardrobe? Or is it lying in the bank? So when you receive salaries or later on, it'll probably hit your bank. And then what does the bank give you in return? As a savings bank, the interest is under 3% today. But when you want to use that money, you want to buy something tomorrow, go out, spend on something, you realize that the price of that product or service has gone up by 7%, 8%, 9%, 10% sometimes. And your money is growing here at just 3%, under 3%. So if you leave your money in the bank, month on month on month, what is happening? Prices are going up by in excess of 7%, 8%. You will not be able to afford the same things you were able to afford earlier, because inflation is, eating up all your savings, isn't it? So there'll be a clear-cut gap. Expensiveness, which is inflation, is growing at a much faster rate, a higher rate than the rate at which your savings is growing. And there lies a problem. And how this can really affect a household is explained in this particular slide. If you see on your left-hand side, what impact inflation can really have on a middle class family who's spending about 30,000 rupees today on their expenses. Expenses could include anything. It could include groceries, it could include telecommunications, entertainment, medical expenses, rental expenses, transport and conveyance. All of these are typical expenses that you cannot do without. They are must incurred expenses on a monthly basis. So if a middle class family is spending 30,000 rupees today, and I'm assuming just a 5% inflation, then in 5 years' time, this family would need to spend 10,000 rupees more on buying the same things. And in 15 years, which is 15 years from today, they would need to spend twice the amount of money, double the amount of money to stand in the same place. Not that they are buying anything more, not that they are increasing their standard of living by better quality products. It's the same products in the same quantity, but you're paying twice price for that product. So you can imagine inflation is a silent killer, and very few of us know this, understand this. So this is something that we all need to be aware of. So what is the solution? The solution is that savings is not enough. You need to progress. You need to start. Savings lying in the bank is lazy money. And you need to start putting that lazy money to work. Start taking the money to the gym, as I would call it. And that gym is nothing but investments. When you start putting your money into different financial assets, for a higher return, and returns don't come without risk. The higher return that you try to achieve, the riskier it gets. But then you're putting your money to work. And you're working why? For achieving your goals. This is what investing is all about. Okay? And without which, you will not be able to meet or achieve a lot of your dreams. So it's not only essential that you fight inflation, but also create wealth. And the moment you're getting a return higher than inflation, it is then that you are generating wealth for yourself. If you're meeting inflation, your return is equal to inflation, you're only maintaining your standard of living. But the moment you achieve a return higher than inflation, any percentage point higher than inflation, the more wealth you're creating for yourself. Okay? So where do you start? The point is to start planning first, because failing to plan is planning to fail. And it's very important that the first step in that is basically to have to define where you really want to go, what your goals are. Unless you know your aim, your goal, your dreams, how would you know how to plan for them? So define your goals first. Define in a piece of paper or in the computer. A paper would be better. Start writing your goals. Okay, this is the goal that I would like to achieve. Put a time frame to it. Okay, I would like to achieve this goal in 3 years. This particular goal I would like to achieve in 5 years. This particular goal in 7 or 10 or 15 or 20 years. Put a priority to it. Okay, this is must have. This is a priority goal, right? I have to achieve this, or this is a good to have goal, maybe not necessary. So prioritize in that sense, and put a cost to it. Put a quantification element to it, which means put a price to that goal, because a goal without a price is just a goal itself. It's just an aspiration. So put a price to it, that okay, this goal will cost me so much. If I have to incur that goal today, if I have to achieve that today, how much would it cost me? So put a price to it. And that would be your starting point. Define your financial goals. Then assess your situation. How are you doing financially right now at this point in time? What is your situation? What is the income that you're receiving? What is it that you're spending on? What's your own profit and loss account? once you have this information, then okay, this is my income, this is my expenses, this is what I'm actually saving at the end of the month. And these are the assets that I have. Just the way you do your accounting. For a company, you do corporate accounting, or you're, making accounts for people. You do it for yourself. So the assessing financial situation is very important. Then also evaluating the kind of risk that you're able to take. Every person is different with different risk profiles. Some people can, they like to take more risk. Some people are very cautious. You need to assess your situation, that whether you can take risks or not. And then, define a certain allocation, so some kind of a mix of investments. Like, okay, this I can put it in, say, equity markets or debt markets or in liquid or commodities, all of that, and starts putting things accordingly. Putting your investments accordingly and tracking. Now, these are only the steps of financial planning, and I'll discuss this in a little more detail as we go forward. But the starting step, very importantly, starts with defining your goals and assessing your financial situation, and that's something that you need to do. Okay, and this will help you. Once you start planning, it will help you later on, because you will, you already, you will know, you will be able to assess your financial situation. You will be able to assess yourself, and you will be starting to be more disciplined in your approach. This will also help you enhance your standard of living, because it will avoid wastages, right? You'll start using your time and your money in every bit, in every way, to deploy it in the right places, right? You'll also be able to plan for emergencies, because all these factors will be a part of that plan. Even emergencies, in case there is an emergency happen, then what do you do with your finances? That also will be factored into the plan. And obviously, tax saving again is very important. How you can invest, grow your money, yet save your taxes. So that also forms part of the plan. Okay, because money saved is money earned. And then overall, once you're able to do this, you're on the path to creating that wealth for yourself slowly but steadily. Then obviously it brings you peace of mind. Once you're achieving your goals, you get that peace of mind. Okay, so these are all very, very important. But all of this can be done only if you can secure your income. Because tomorrow, when each one of you is working, you're getting your salary, and we all know that in today's day and age, the job market is not very certain. We have so many uncertainties that come our way. And if you see, right from COVID, when you're stuck into 20, things became so uncertain, and you never know, things can happen again, God forbid. But that really taught us a lesson, that things are never sure. And a lot of people who were earning a certain amount of income, and they were only depending on a salary income, that was their sole source of income. When COVID really hit, then some people lost their jobs. So a lot of people had to do with salary cuts. And then what would really they do? How would they meet their expenses? Because a lot of people didn't have adequate amount of savings or investments. So they had to resort to borrowings, to borrow to meet their ends meet, or they had to cut down their expenses big time. Now that actually taught us a lesson, really, that you cannot, in today's day and age, you cannot rely on a single source of income. Even right now, as we speak, AI is taking away so many of the jobs. So many jobs are getting automated. You don't require that kind of manpower to do transactional jobs. And even now, intelligence jobs which are creative, have also been taken over by AI. So we are progressing in a world where not many people are required, where earlier so many people are required to do just one particular job. So life is a little uncertain right now. Technology, AI, uncertainties are taking over. So you cannot depend on single source of income, and you have to create a second source. And how would you really do that? So moment you do have a job, you have a salary that is coming in, right from the beginning, start putting away at least 5% aside of that salary, and create a fund for yourself. Call it a security fund. Keep putting that money into this particular security fund month on month on month on month. Start building it up. Because in case 2 or 3 or 4 years down the line, in case something happens to your job, or there's a salary cut, you know that you have a fund build up which you can use to generate a second source of income. So that you will not completely be, left without holding a hand. So this will become a little bit of a, this fund will be a hand holding, for you a little bit, to help you tide over the crisis till you find another job, or till your, things get back to normal. So this is again very, very important. And that's what's emphasized by Warren Buffett here in this quote. He says, never depend on single income. Make investment to create a second source. So apart from that investment that you make, you can also do something on the side, something like a vocation or something which is not related to your job. It's just your interest. That could also create a source of income. Now, the more the sources of income, the the less riskier your income, your income pie gets, right? So if one gets affected, the other one is still working. So that helps a lot when you go forward. So what are we really doing all this for? All this money, all this planning is going only towards achieving our goals, achieving our dreams. And some of it is depicted in this particular slide here. You see, a lot of you would want to pursue a higher course of education, right? So education expenses are growing at almost 10%. We spoke about inflation at 5-6%. That's the rate I was assuming, but education inflation is almost 10% per annum. So if you want to pursue, you want to study further, you want to acquire higher skill sets, then you need to pay a lot of money. And education is not cheap anymore. It's very, very expensive. Okay, so that's one part. Then, buying a house, funding down payment of a house, right? So that could be another goal. Traveling, going for holidays inside India, outside, that again costs a lot of money. Buying a car, buying a comfortable vehicle to be able to travel in, starting a family. So many of these goals are there. Taking care of your parents, for instance, starting a fund for them, and or maybe building up a fund to start your own business later on. You want to invest something in your own business and you want to start a fund for that. So that could be another goal. So these are the goals I was telling you about. Okay, document them because it's so important that you document these goals. If you want to really be able to achieve them. And last but not the least, retirement, which a lot of people ignore because they feel that, okay, no, we are so young, we are just starting out, why should we think of retirement? But remember, you cannot plan the future in the future. You might start working when you're 23 or 25 years old, and you might work all the way till 50, 55, 60 maybe. And after that, you decide, okay, no, I don't want to work as much now. I want to, I want to be able to have some free time on my own. Then, and you happen to live till about 85, 90 years, So in those 25, 30 years that you have, you're not earning any money or good amount of money. How are you going to meet your standard of living? How are you going to incur those expenses? So you need a fund. The higher your standard of living during these years, you want to maintain that standard of living, right? So you will need to have that kind of money at that time frame to be able to sustain yourself. So you have to build up a solid retirement fund. And that journey starts right in the beginning. Putting bit by bit by bit by bit and getting to that point. So retirement goal would be the end goal at that point in time. So these are the goals that we are looking at. So remember, whenever you're investing, always have a goal in mind. Don't say I want to create more money, I want to create wealth, I want to become rich, because those are all abstract terms. Unless your money finds a destination, unless it finds a goal to achieve, nothing is going to really make you happy. Right? So these goals, as we speak, are becoming more and more expensive, right? Because of inflation. And those are the goals that you have to really achieve, right? So have that goal in mind before making any investment that you do. Target it towards goal. Then you will have respect for that goal. You'll have respect for that particular investment. Okay, so this is a very important fact, and that's what I'm asking you to document. So what are the options that are available to us? Quite a few actually, but I'm gonna, these are all the ones, the things that you see on the left hand side are all the instruments, all the financial places that you can actually invest in. And if we start with the lower one, property. Property is something that you can only do at a later stage in life, not right now, because as students, you're not earning as much. This is only when you have a stable income, you have a good amount of income that you can actually think about property. So let's keep that aside. Insurance is again not an investment. It is basically protect your dependents, your family in case something happens to you. So again, this is not an investment in strict terms. We'll have to zero down, to the best ones. So I'm coming to that. Bank deposits. Now, bank deposits is the most popular form of investments. But, because why I would say it's very popular is because 65% of Indians actually put their money into bank deposits, and a lot of them just let it be there. They don't do anything more. And what does the bank give you? They hardly give you a good return. Maybe 6%, 6.5%, maybe in a good time 7%. And then taxes cut on that income if you're on a higher income bracket. And then you cannot take out your money when you need it. Then what's the point? Yet a lot of people invest in bank deposits because they think banks are secure. But they're secure only to the extent of 5 lakh rupees. Beyond that, a bank is not secure. So leaving all your money, maybe some amount of money is okay, but all your money in the bank is not a good idea. Coming to the one above that, bonds. Bonds give you a slightly better return than bank deposits. Again, they get riskier slightly, but yet they are locked in instruments. You cannot take your money out when you need it. Okay. So let us look at the other two assets that we left out. Right on top, on the left hand side, you have gold, and in the middle you have stocks. Stocks means equity markets. Now these two assets have done extremely well. They're liquid. You can take your money out whenever you want, and they have given they have given returns which are much higher than any of these other assets that you see below. Much higher. And let me show you this by way of a chart. If you see the Sensex, it's gone up quite a lot. It's been going up and down, but it's moved. The trajectory is going up as we speak. And if you look at the rolling returns, of 5-year rolling returns of the equity markets, you see any 5-year period that you see, or a 5-year, 10-year period, 15, 20, 25-year period, if you see the kind of returns that are coming through, in an average, you'll see returns are varying between 11 to 12%, 12% on the lower side to about 14.5%, 15% on the higher side. So 5-year period, 10-year period, 15-year period, 20-year period, just see the kind of returns. And over 35-year period, it's almost 14%. Even on a 20-year period, some excess of 15%. So even if I assume somewhere, somewhere in between, say 13% is pretty reasonable to expect, right? 13% is very reasonable to expect, 13.5 to 14%. So this is the kind of returns. This is much higher than inflation. Inflation, even if I consider street level inflation to be 6 to 7%, stock markets are growing at double the rate of inflation, which means that's where you're creating wealth. And even if you look at gold has also gone up quite a lot. It's given about close to 12% return in about last 25 years. And this year itself, gold prices have gone up by 50%. When things are uncertain, these are the assets that do well. So this is where we should be. But very few people know how to really invest in these assets, because they go directly put their money into markets with limited amount of understanding. They don't know which stocks to buy. And even if they think that they bought a stock, when to buy it, when to sell it, when to come out of it, how long to hold it, all of these become very complicated issues, because this requires time. It requires skill. It requires a certain amount of commitment, to be able to be successful. It also requires a little bit of financial scale to be able to build up a solid portfolio. Not that you can't do it. You can always do it at a later stage in life, slow and steadily. But this is not the only thing that you should be doing. A small portion of this is okay. Even gold for that matter. Even if you're investing your money into gold, and suppose you go to a jeweler shop to buy physical gold, because people feel comfortable, oh, I have gold, physical gold in my hands. But then how do you know whether it's 22 karat, 21 karat, or it's an 18 karat gold? It may not be really pure. And then how to dilute, how to sell it when you want to sell it. These become very complicated issues. But you have financial instruments which help you invest in them. So this decision about what to buy, when to sell becomes extremely complicated. And when you're going directly into these particular assets. So what comes to our rescue? What comes to our rescue is mutual funds that you see on your right hand side. They are your answer. They are your key to achieving your dreams. Now, mutual funds are not investments on their own. They are basically vehicles to investments. They basically launch schemes which invest in gold, invest in stock markets, invest in fixed income securities. And the kind of return that they achieve through adequate amount of management is a return that comes to the scheme and in turn to you. So mutual fund is not an investment. You don't invest in a mutual fund, you invest through a mutual fund. But then they are the ones who are taking all that headache. They are the ones who are doing all that management. You are not taking that headache. It is their expertise that you are looking at. Right? So you invest in them and you generate a return. And the advantages are many. Right? Advantages are many, and I'll come to that in a bit. So the thing is, the first thing before you start making an investment is to have a checklist. Is my investment fighting inflation or not? Because if it's not fighting inflation, if your return on investment is lower than inflation, you're getting poorer. If it's higher than inflation, you're creating wealth for yourself. Does your investment give you an income when you need it? You should be able to get an income if you require an income at that point in time. If you feel there's a need, then your investment should be able to give you that income. Is it accessible? Can it be broken into parts without any extra cost incurred? For instance, a fixed deposit. If you make a deposit of 50,000 rupees and you want to take 10,000 rupees out, you have to break the entire deposit. And then you pay a penalty and also a lower interest. You have to compromise on a lower interest. So that's not user friendly. Mutual funds, they're nothing like this at all. You can take as much as you want without any penalty that is charged. Does your investment grow in value and appreciate over a period of time? So even in the short to medium term, it's going up and down. There are fluctuations in markets, but in the long run, if it's getting you to your destination, if it's getting you to your goals, then that's a good investment. Not an investment which is growing, but it's growing at such a slow speed, like a fixed deposit, that it doesn't get you to your destination when you actually want to get there. So if there is a smarter investment which maybe soars, which turns, which goes here and there, but it gets to your destination, then that's what it all matters, right? Okay. So, equity markets, mutual fund equity markets are much better for that particular purpose. And then when you're making investment, how is it available? Is it being made at a reasonable price? You should not be making an investment of 50,000 and then incurring, 5,000 rupees only on cost. It's basically, the purpose is defeated. So these are things that you should actually watch out for. And also, it's very important here to explain to you the concept of asset allocation. You see, when you start making investments, in different assets, like it could be stock market, which is equity market, or debt markets, or fixed income markets, or the commodity markets like gold or silver, and in certain liquid investments, for emergencies, then that mix is called an asset allocation. How your money is being invested in different assets, and high level assets. So this is like the equity, the asset allocation. And in the beginning, most of your assets, is my recommendation, most of your investment should be in the equity markets, because equity markets have done extremely well in the long run, as we have seen. And so for your long-term goals, and long-term I would define as any goal which is beyond 5 years. If a goal is beyond 5 years, you should be investing in the equity markets, But if there's a goal, which is 5 years or less, which is medium to short term, then you should not be relying too much on equity markets, but rely more on the debt market, the fixed income markets. Fixed income markets do not give a very high return. Your return could vary between 7% to 8.5%, but then they are more certain in the short to medium term. Whereas equity is not. Stock markets are they are much more consistent as the time period increases. So for your long-term goals like retirement or house or these kind of things, you should look at equity markets. For your short-term goals, okay, say you want to buy a laptop, or you want to go for a holiday, or you want to buy a bike or something. These are short to medium-term goals where you have to rely more on the debt markets. And obviously you have to keep certain amount of money for emergencies. Some expenses come out which are not planned, and they're unplanned expenses. So for those, you need to have some liquid funds also with you. So this mix is called asset allocation. And in the beginning, it should be tilting towards equity. But as you go forward, you move in life, then, you obviously your responsibilities increase. You are, you cannot risk as much as you could risk when you were younger. And that should start tilting towards the debt market. So this shift is asset allocation. There's a shift in asset allocation as you start getting older. So you don't expect a guy at 55 to take the same risk as a guy who's 25 years old, right? So that's a shift that happens. So this is very important, and it's just like this thali that you see right here, because the thali you see is a very good example. Because the thali has got all the ingredients for a physical well-being. It has got carbohydrates, it's got vitamins, things, it's got it's got proteins, it's got fiber, it's got sweet, it's got salt, it's got all of those mixes are very important for your physical well-being. Similarly, when you're putting your money into different assets, your asset allocation, which should actually match your targeted goals, it should help you achieve your goals, then that asset allocation is a balanced asset allocation. And a lot of your achievement in terms of your goal achievement depends on how this mix happens, like how you're able to define your asset allocation and are able to achieve your goals. Too much of equity or too much of debt at one side can ruin it. Like the way with the thali, if anything is in excess in this thali, then it can ruin your health. So a balanced approach is very, very important. So coming to mutual funds. So what are these mutual funds? So let's take this a little deeper. And what instruments we are interested in. So mutual funds are basically pooled investments. As I said, they launch schemes and investors invest in those schemes, and because they invest in those schemes, it becomes a large pool of money. And this pool is managed by someone called a fund manager. He is the one. His team drives this fund, and they basically they use this money to invest so that they're able to achieve higher returns. And usually, these returns, they aim to beat the market. They basically aim to get returns higher than the market, so that they have performed. So if there's an average, if they've done better than the average, they have outperformed the market. That's what they achieve, and this is what really usually happens, because they are very much into the market, and also the costs are very, very reasonable. The cost is it's a cost efficient product. For instance, because there's so many investors investing in these schemes, that the cost per scheme gets apportioned among so many different investors. So they're also cost efficient. Like you going directly and buying something versus going through a mutual fund. Obviously, a mutual fund will be far cheaper than you going and buying directly. And we've seen that in the long run, they have done much, much better than the markets on an average. But remember, no returns are guaranteed. No returns are guaranteed in mutual funds. It's based on the past and how they have done in the past, and what we look into the future. We kind of make a judgment on markets and all of those things to be able to define that, okay, this is the kind of return that you can expect. Okay, there's no return guaranteed. Nowhere will it be written that, okay, this is the return that you'll get out of a mutual fund. That's not the case. So let's understand how this really works. So you have a mutual fund coming out with a scheme. Let's say it's an equity scheme, which means this scheme is basically aimed towards achieving capital appreciation. So if its capital appreciation is the objective, then that money will be going into the equity markets, because that equity markets are designed for capital appreciation. So this scheme is there, and you as an investor are wanting to invest in the scheme maybe for a 5-year period, just assuming a 5-year period for now, because you want your money to grow. So you put in, say, 10,000 rupees, for instance, and in return you get units in the mutual fund scheme. Like each unit is 10 rupees, so you get about 1,000 units. And like you, there could be many other investors, prospective investors, who would want to invest in this mutual fund. Some putting in 20,000, some putting in 5,000, some putting in 50, some putting in a lakh, in different amount of money that they would want to invest. And each one is getting units, equivalent units. So now when all this money really comes in, it becomes a large pool of money, right? Which is now, once this pool of money is there, then this is managed. This is now to be managed by this fund manager, the man that you see on the right. And he or she is assisted by his team of analysts, who basically analyzing sectors, analyzing companies. They're doing a lot of Excel sheets, meeting people, meeting managements, trying to get the real analysis out, and finally coming out with a list of companies that they believe could be potential candidates for their securities investment, for their portfolio. I mean, they would be looking at companies which they believe will grow much more than today, in the future, and their share prices are not reflecting their future growth. Or they would be looking at companies which have share prices of which have come down so much that the prices have gone below their intrinsic value, and they believe these are cheap companies to buy, and so they look at those companies. So at this point, so once all of these, they make decisions, okay, which companies to buy, then it becomes a part of their portfolio. They pick up these companies from the stock market, and they form a portfolio of 50, 60 companies. And once they believe that these are the companies that are going to do extremely well in future, the share prices are likely to move up. Now let's fast forward 5 years from now. What can really happen? In 5-year period, in this particular portfolio, there could be some companies which could have done extremely well. Their share price would have gone up quite a lot. There could be some companies which may not have done very well. There could be some companies which could have outperformed the market. There could be some companies which moved in line with the market. So on an overall, on an average, we've noticed that in about 5 to 6 years, usually values in these equity mutual funds tend to double. This is this is what we've seen over a period of time. And if this happens, then what happens to your 10,000 rupees? The unit value of 10 rupees of the mutual fund has now gone up to 20, and your 10,000 rupees would go up to 20,000 rupees. Similarly, values have doubled. So each investor who's there in the fund would decide what they already want to do. Some investors might want to come out. You can also decide if you want to come out of this fund and achieve your goal, to put it in your goal. Or you can decide to take some money out. You can also decide, okay, not to take your money out at all, let the money be there. Each investor will do as they believe is right for them. There could also be new investors coming in and investing it at the unit value of 20 rupees. Because they want to invest now and they want to ride this fund for the future. This cycle carries on and on. It continues. It keeps round and round. It carries on. Stocks are bought, stocks are sold, new funds are bought, new companies are sold, funds are bought and sold by investors, and this cycle carries on. A mutual fund really never ends. It carries on and on and on. So this is the way it really works. And the advantages are many. You get advantage of professional management because the fund manager and his team are professionals. Then because the fund has been distributed, so many stocks and securities have been bought in different sectors, different sizes of companies, large, mid, small, that it's very well diversified, that anything negative impact of a couple of sectors is compensated by the positivity of other sectors. So this diversification is very important. This is something that we cannot do on our own when we are investing directly in the markets. We are not able to do that on our own because initially we don't have that kind of money to diversify adequately. But through a mutual fund, you can do that right from the beginning. You can do that right now. Then mutual funds are monitored or regulated by SEBI, Securities and Exchange Board of India, which lays out the guidelines, the rules and guidelines as to how much a mutual fund can really, invest in one particular company or in one particular group. And many, many others. There are lots of other guidelines, but these are some of the important guidelines which basically helps put a barrier that investor the fund does not go beyond its boundaries. It does not over invest in some particular group or over invest in some particular company, because that becomes a risk. So there are clear cut guidelines that are put forward for the interest of investors. Then liquidity, very important. So in a mutual fund scheme, you can come into a mutual fund or get out of a mutual fund whenever you like. No questions asked. The door is always open. So you can't do that in a fixed deposit. Fixed deposit, if it's a 3-year or a 5-year deposit, you have to be there invested for 3 years or 5 years. You cannot take your money out, even if it's an emergency. But in case of a mutual fund, even if you're investing for 10 years, in 3 years, if there's an emergency that comes up, you need that money, then you can withdraw as much as you want, meet that emergency, and put that money back later on when you feel it's okay. So that gives a lot of comforting factor. Liquidity is a very, very important thing these days, that you have access to the money when you need it. And then the best part is you can invest as little as 500 rupees a month in a mutual fund. As little as 500 rupees a month. So anyone can afford to invest in a mutual fund. You don't require lots of money, which is unlike a deposit account or a post office savings account or a corporate deposit account or a bond or anything like that. All you require is just 500 rupees to be starting an investment account in a mutual fund. Okay, so anyone can afford it. So these are very, very important advantages that a mutual fund really carries. So let's look at a structure of a mutual fund. How does really who are the stakeholders here? So the stakeholders basically are on the right hand side. If you see, there's an asset management company, and Sundaram Mutual Fund, who's sponsoring this particular session, is one such asset management company out of maybe about 51 asset management companies are there, and the list is growing, as we speak. So they are the ones who manage the assets, and they launch the schemes, and investors invest in those particular schemes. And asset management companies are supported by agents and distributors. You would have heard a lot of mutual fund agents, advisors, distributors who have the knowledge of mutual funds. They're empaneled with these mutual fund houses. One such house is in Sundaram Mutual Fund. There are many others. And they have the knowledge because mutual fund houses are in touch with them, They know, they are aware of the schemes. And if you want to make investment in mutual fund, the agents and distributors are the right people to approach so that they can help you look at your goals, map or match the investments to your goals, and accordingly, make those investments, track those investments, and help you out, assist you. Okay. Then there are bankers, there are fund accountants, and there are also registrar and transfer agents whose basic role is to basically Do you issue account statements like the way your bank issues statements to you? The registrar and transfer agents basically issue statements on your transactions in mutual funds, right? They also account for the units that have been bought and sold from a mutual fund scheme to investors and from investors. So they keep a track of those, the units in that sense. And they also help assist in doing KYC through their KRA, through the KYC registration agencies, which we call KRA. So they also help in doing that particular work. So this is like a structure, a full structure of the way a mutual fund actually works. Coming to the types of mutual fund, how mutual funds categorize, and because mutual funds are investing in so many different assets in so many different ways, there could be many different ways of categorizing them. But the most popular categorization, I would say, is the fourth column from the left, which is investment portfolio. Because this is very simple. They are categorized based on where they are putting their money. For instance, if a mutual fund scheme is putting their money in the stock market, it's an equity fund. If they're putting their money in the fixed income market, like government securities, bonds, debentures, all of that, so which gives interest, they are basically investing in the debt market. If one scheme is investing in two different assets, like equity markets and also fixed income markets, then they are called hybrid. And if they're investing in the money market, which is maturing, money market instruments mature in under 1 year, then they are called liquid fund. They're very liquid. You get money in your hands very quickly. Okay, so let's discuss each one of these as we move forward. Starting with equity schemes. So equity schemes, as we know, they are, as I've told you earlier and I've shown you earlier, they are basically geared towards creating wealth for you in the long run. Remember that long run is very, very important. If it's something, if there's an instrument that is generating wealth for you in the long run, that is a far better instrument than generating wealth in the short run. Because short run only that much wealth will be generated, but in the long run, wealth generation means wealth generation year on year on year on year. Okay, there is volatility, there is ups and downs, but then they generally achieve their destination. So these are suitable for investors who can take that volatility in their stride. Remember, the short-term pain is better for a long-term gain. If you can take the short-term pain of volatility to achieve that long-term gain, then it is far, far better, isn't it? So this is for those people who only want their money to appreciate in the short term right from the day one, then it's not for them. So you have to be comfortable with volatility to be able to achieve your goals, to achieve that wealth. So equity markets are geared towards that. And there can be, equity schemes. There are many, many types of schemes out there, because if you see, there are different, the stock market has got so many different types of companies. They have large companies, you have mid-sized companies, and you have very small companies. And the larger the company, the more branded they are, the more established they are, the bigger they are, and they are not affected so much by economic, changes or policy changes. They are safer, and yet they don't move so fast, so they give you a reasonable return. Coming to mid-sized companies, medium-sized companies, they may be brands, may not be brands. You would have heard of them, you may not have heard of them. But because they're moderate, they give, you can expect a moderate return with moderate risk. Risk and return higher than large cap fund. Then you have the smaller companies right at the bottom. They are very small. Revenues are small, scale is small, market capitalization is small. They get pretty much affected by policy changes, economic changes, or there's some uncertainties in the global markets. They get pretty much affected, both positively and negatively. They are extremely volatile. They tend to move very fast, right? So they are the riskiest among the large, mid, and small. The small ones are the riskiest, but then they hold the scope for the highest returns. If things go right. So you have these three categories of companies, and you have a fund which is investing in each of these categories. Like you have a large cap fund, which will be obviously still safer yet more certain. You have a mid cap fund with moderate risk, moderate returns, and you have a small cap fund with high risk, high return category, right? And then if there is also a fund which invests in all of these three segments, like the multi-cap fund, which you see on the top left. Multi means many, and cap means capitalization. So you have a multi-cap fund which is investing in large companies, medium-sized companies, and small companies in certain proportion. Usually that the minimum percentage is 25% for each of these segments. I mean, this is by law that SEBI has said that, okay, you have to invest 25% in each of this, in any of these segments at any point in time. Okay. So this is like an average fund, which is participating in all these segments. And if I were to recommend you students as, which fund should you be starting your investment? Should you want to start a mutual fund investment? Then multi-cap fund is a good place to start that investment. Because like it's an average fund. So there are many other types of funds that are there. We cannot discuss each one of them, but I'm just discussing some interesting ones just to give you the drift. Then you see the last two here in the last row. You see there is something called sectoral thematic fund. Now this is very interesting because this fund invests in one particular sector, like IT sector or pharma sector. So if you're interested in the IT sector, you believe IT companies are going to do extremely well, then there's an IT sector fund, which will invest only in IT companies. If you're interested in believing in, say, healthcare sector, you believe healthcare is going to do extremely well in the next 5, 7, 10 years, then there is a healthcare fund for you, which will invest only in healthcare related companies like pharmaceutical companies, diagnostic companies, medical insurance companies, gyms, or anything to do with good foods or things like that, and they're investing only in that particular segment. Thematic is a little more broad based, so like say infrastructure. So you believe that, okay, the infrastructure of the country, they will always be spending and these companies will do well. Then you have a fund that is investing only in steel companies, cement companies, engineering companies, infrastructure, or even telecommunication companies which has to do with infrastructure, or energy companies. These are all infrastructure related, so they will invest only in those particular companies. But the risk is highest here because it's very concentrated. It's a concentrated portfolio. Then you're coming to ELSS, Equity Linked Savings Scheme. And this is again very interesting because at some point in time, you will be earning a salary and your employer will be deducting taxes because your salary will become taxable. You would have gone above the income limit, and your employer will deduct TDS or tax deducted at source from your salary. But you also want your money to grow. You also want your money to grow in the equity market. So this is that one fund which will help you not only grow your money but also help you save your tax. So whatever amount you put in this particular fund, subject to a limit of 1,50,000, will not be considered part of your taxable income under Section 80C if you are filing your tax under the old regime. So that part is not considered as your tax, and yet this money is going into the equity markets and helping you achieve growth as well. So this is a fantastic fund for those people who are earning salary income and their money is being taxed. The employer is deducting tax from their salary, and this will help you, to a big extent by shifting your income to subject to the max limit of 1,50,000 to a growth asset. But it has a lock-in period of 3 years. Unlike normal mutual funds, you can buy and sell whenever you want. Here is a lock-in period of 3 years. You cannot take out your money, till 3 years are over. So there is that lock-in period that you must be aware of. Coming to debt schemes. Now, what do debt schemes do? Where do they invest their money? They basically invest their money in government securities, in treasury bills of the government, in commercial paper, which is commercial paper floated by companies, then certificate of deposits floated by banks, then bonds and debentures, call money market, which is under 1 year, and money market instruments. So they invest in these mix of different assets which give an interest income. So interest income comes to this fund, and then there is also a capital appreciation element to it because these funds, they basically trade on debt instruments in the secondary market. These debt papers, government securities, bonds, they're traded. They have a secondary market like the way we have for equity markets, and their prices, these debt instrument prices, go up and down with changing in interest rates in the economy and also the credit rating. So there are a few factors that affect these changes, and these people are able to assess that judiciously because of their the tools and the analytical tools that they have, and the focus and the vision of interest rate movements, and they tend to buy low, sell high, and generate some capital appreciation for the fund. So these are the two sources of income: interest income and capital appreciation. Now, as I said, these debt funds are very good for the medium to short term, for you to invest for your medium to short term goals, but you can also invest in them for the long term as well. So how are they really categorized? If you see here, they on the x-axis you have maturity. So maturity is very important factor. Ki how long, what kind of instruments, what is the tenor of the instrument that they're investing in. So that's on the x-axis, and the risk is on the y-axis. As you go up. So if you see here, and the green bars are basically the indicators here. So if you see the lowest one, overnight fund, has the lowest risk. What is overnight fund? Just 1 day lending, which means if I lend money to you for if today and you give it to me tomorrow, then I charge you 1 day's interest. That's an overnight fund and has the lowest amount of risk. And as you go up that bar, up that ladder, up this chart, you see you get to medium to long duration fund, on a higher stage, where the duration is much longer, but so is the risk, because they're more sensitive to interest rates at that point in time. The longer in the debt markets, the longer the tenor, the longer the time of maturity, the more the risk, because then those funds are more sensitive to interest rate movements. So the longer the maturity, more the sensitivity to interest rates. This is what it tries to basically explain. And these are the categorized. If you see you have an overnight fund which is maturing, which has got securities which mature in 1 day. Then you have a liquid fund, the second one, which securities mature in just about 90 days, average maturity, right? So the returns will also be lower, So in a liquid fund, you can expect a return of under 5%. But as you go longer and longer, though the risk increases, the return also increases. For instance, you have a short duration fund, in the middle column on the right hand side. See, the maturity is between 1 and 3 years. Now, how would you plan a goal? So suppose you want to plan a goal, say, for holiday going. No, you want to plan for a holiday, say 2 years down the line. 2 years is too short for investing in equity markets, but it can at least give you a return better than a savings bank account. If your bank is giving you under 3% return and you want to plan for a holiday, take that money out of the bank, put it into a short duration fund for maybe 1 to 3 year time frame, because this fund would probably give you a 6% return, and it's liquid. Whenever you want, you can take out that money. So put that money in this particular fund for your holiday goal. And like this, as the duration increases, you can put your money based on your goal. So if your goal is, say, 5 years or 7 year duration, and you don't want to take too much of risk in the equity markets, then maybe you can go for a long duration fund, top left hand corner. It has got a maturity of greater than 7 years, but so you can expect a high return from here in excess of about 7.5 to 8%. Right? And it's liquid. The fact that you're not locked into a fixed deposit, you can take out your money whenever you want. And you're able to achieve your goal. You know what the kind of return you can possibly get. So this is how you plan your goals. So this is debt funds. Coming to hybrid funds, as I said, hybrid fund, if you see this chart here, it's got both equity and debt in different proportions. So this is where hybrid comes in. Now the categorization of hybrid is basically depends on how much money is gone into equity and how much money into debt. Sorry. The equity portion basically gives the growth. It basically pumps the growth in this particular fund. And the debt portion gives you the platform for that growth, because debt funds are a little more stable. Returns can vary between 6 to 7% to 7.5%, whereas the equity markets return can vary anywhere between 11, 12 to 14, 15%. Now, the mix is what determines the categorization. For instance, you have a conservative hybrid fund. Conservative means being more secured. So here you see a 10 to 25% mix is in the equity market, and the remaining is in the debt market, 75 to 90%. So majority of the money is going into the debt instruments because it's a conservative hybrid fund. It's not an aggressive hybrid fund. So that basically the 10 to 25% just provides a kicker to the overall fund, the returns of the overall fund. Then there's a balanced hybrid, a 50-50 scenario. It's evenly matched with a 40 to 60% range in each of equity or debt. And coming to aggressive hybrid fund, this is basically for those people who want returns of equity market, but they also want a little cushion of safety in debt markets. So 65% to 80% is in the equity markets, but the balance 20 to 35% is in the debt markets. Just in case the equity markets fall, then at least there is a certain cushion, because debt markets because they are always getting some kind of interest income in them and capital appreciation. It keeps on growing. So there's a little cushion there for a little bit of safety. So you see, every fund that a mutual fund issues, or any category is there, it's fine tuned to the kind of to a person, to the nature of a person and to the goal. That's why mutual funds are so robust, because you have any scheme which can suit a person's profile, goals, the kind of risk that a person can take, from conservative to aggressive, right? So this is hybrid funds. And then you have solution oriented funds. Now, solution oriented funds means you have the name of the solution or the goal enshrined in the name of the fund itself, because a lot of people find it very complicated to basically invest in, say, to choose which fund should I be choosing to meet my retirement, retirement fund, or to my retirement, or which fund should I be choosing for my children. Should it be a large cap fund, a diversified fund, or a combination of mid cap, large cap? So they don't know, because they only have these nomenclatures, and they don't know which funds to really choose from. Though you can use all those funds to meet your retirement goals or your children's education fund or marriage fund, but some people, they don't want to take that. They don't want to move around and figure it out. So what AMFI and SEBI have done is they have basically put the name of the goal in the fund itself to make things easier for people to decide. So here you have a retirement fund, which is a retirement fund is for your retirement funding. So people who want to build a retirement fund, they can go there and invest in a retirement fund. But here there's a lock-in period of 5 years, or retirement age, whichever comes first. So that's a catch for children's education, or for children's education or their marriage funding. You have a children's fund. Again, there's a lock-in period of 5 years, or till the child turns majority age, whichever comes first. Remember, these are the locked-in funds. If there's a solution-oriented fund, they're locked in. In case of a normal fund like a large cap, mid cap, there's no lock-in period. Only here there is a lock-in period. So these are solution-oriented. Now coming to the other types of fund, you have an index fund. In case of an index fund, someone wants to invest in the market itself. In the market, where do you really go? You don't want to invest in a fund that is being managed by a fund manager very actively or trying to outperform the market. You want to invest in the market itself. Then your answer is basically an index fund. Because this index fund will basically replicate the index. It'll have the same stocks in the portfolio as the index in the same weightages. So it'll give you the same return. Like if an index, like a Nifty index, say you're investing in the Nifty index fund, like, because this is going to track the Nifty. So if the Nifty gives 13% return, the Nifty index fund will also give you approximately 13% return. And the advantages are many. The fact is that any of these companies that form part of the index are usually good companies. They're good companies that are formed part of the index. The best part is that which companies form part of the index, and so what companies are going to be a part of your index fund. So you are aware, which companies are going to be invested in. And then the third very important is the fact that these funds are, the expense ratio to manage these funds are very, very low compared to normal equity funds, because there's no active management involved. You just have to replicate the portfolio of an index. So the fees are capped. The fees are very limited in that sense. And that savings comes as a return to every investor. So this is the advantage of an index fund, investing in an index fund. And then there are exchange traded funds. This is also another category of mutual funds. And for these funds, they are listed in the stock market and traded in the market, like just like the way any other stock is traded. So for these, you have to have a demat account, you have to have a stockbroking account. Remember, for normal mutual fund investments, you do not require a stock market, a broking account, or a demat account. But for these, you have to have a stockbroking account and a demat account. And they are traded like any other stock, and their prices also vary. Unlike the other normal mutual fund, where the prices comes at the end of the month, which is mark to market. So you have an end of the day price. That's one price. In this particular case, prices are fluctuating every minute, every second, just like any other stock. And you pay brokerage charges to buy these. You can sell them whenever you want. That's because they are exchange traded. And if this is in gold, if this fund is monitoring gold prices, then it's called a gold exchange traded fund, because gold becomes the benchmark. So if you want to invest in gold, you don't have to buy physical gold. You don't have to go to the jeweler. You can buy a gold exchange traded fund from the stock market itself. You can trade in gold through an exchange traded fund. And the benchmark is gold prices, world gold prices, so global gold prices, which is the best benchmark. It's a global instrument. It's a global asset, isn't it? So it's global prices. So Then we come to international funds. Now here the funds basically are this international fund. If you want to now invest in global assets beyond the boundaries of the country, beyond India, then you have an international fund that you can invest into, because this fund would invest in a global mutual fund, which can invest in international equity markets, international instruments, international exchange traded funds. So indirectly, by investing in this particular fund, you are getting an international exposure beyond the boundaries of the country. So imagine you're not just investing in India. I mean, mutual funds just don't provide you a platform investing in Indian companies. They provide you a platform where you can get exposure to global companies as well, global companies, global instruments as well. And imagine, so see the extent of diversification that can really happen through mutual funds. Okay, so but there's a catch here. There is a catch here.
Hello.
There's a catch here, and the catch here is basically that these funds are slightly more expensive, because of the fact that they're investing indirectly. And then there's also currency exchange rate risk. When money gets converted, your rupees, when you're investing in the fund, gets converted into dollars or into rupees. And when you have to redeem these funds, then that dollar or rupees are getting reconverted back into the dollar and are getting reconverted back into your rupees. So there's that exchange rate risk that can happen. So these are two of the challenges in investing in international funds. But then it gives you the diversification. Okay. So so in this case, you see which one to buy. It's always a matter of risk and return trade-off. How much risk you can take, and that's why it's so important to assess your risk. So in equity schemes, you have a high return, high risk. In hybrid schemes, moderate returns, moderate risk. Debt schemes, low returns, moderate risk again. And liquid fund is very, very low. Both are very, very low. So there's always that risk-return trade-off that you have to deal with. But if you're able to manage your risks well, getting a high return, then that's the best way to go forward. So let's start with what are the documents that should be reading to achieve all of this, because some amount of reading is very importantly required. And the important documents that you must go through these are the mutual fund related, scheme related documents. And to cut long things short, the document that you should focus on is the third one there, the key information memorandum. Because the first two documents are very detailed. They are more detailed, they are more technical. Scheme information document, which is focused towards scheme, so you'll have a detail on the scheme. You have a statement of additional information, which have detail on the taxes, on the legal matters, on the sponsors, on the mutual fund house itself, and it will have very common related information. It doesn't change, with the schemes. What changes is the scheme related information which the mutual fund is launching. Now, the key information memorandum is basically gives you an abridged. It gives you a summarized, simpler version of the first two documents. And I would recommend don't waste your time on the first two. Go and download the key information memorandum of a mutual fund here, of any particular mutual fund scheme that is being launched, and go through it, because it will have details of the scheme, which means the name of the scheme, the investment objective, the investment strategy, the probable asset allocation, who are the fund managers. It will give their profiles, what will be the likely expense ratio that is going to be there. It'll give you a little bit of story behind why this scheme being launched, and that's a good information to have. Plus, it will give you information of other schemes that are being managed by the same asset management company, so you can actually see how they have performed. So this is very important information to have to be able to get you going. And the other document that you must see is, and this is a very good document, because this is like the report card of a mutual fund scheme, which comes out at the end of the month. Like today we are on the 14th, the 15th of November. You'll have the fund fact sheet for the 31st of October, and this document basically shows the portfolio of the existing schemes, what stocks they are holding, in what proportion, what is the sectoral allocation, how much money into FMCG, how much money into banking, how much money into engineering companies. So there is a mix. The sectoral composition is there. So for the scheme, you'll also have a performance table, like how have they performed in 1 year, 3 year, 5 year, since inception, and also the benchmark performance, like which index has it been benchmarked to. So you can see that if the scheme has done better than the benchmark, it has outperformed for that particular period. So you can assess all of that. Then you'll have some risk return ratios, which tell you how much return has the scheme provided given versus the kind of risk it has taken. So you'll have some risk return ratios there. You'll have your investment objective. So this information is very, very useful to be able for you to assess whether this scheme is suitable for you or not. So that fact sheet is very important. So now, how do you start investing your money? So there are two routes to go through. One is a regular route, which is, you're going through a mutual fund distributor, who gives you the assistance and help. So I remember I told you about a mutual fund distributor who you can go to for help. So if you're going through them, they will take you through a regular plan, and the regular plan has a lower unit value because there is a certain amount of commission that is cut from that scheme value, because of the kind of services that the mutual fund offers, the investment advice, the mapping, the execution, all of that. So it's got a higher expense ratio, and that's why there's a lower unit value. On the other side, if you want to go directly, which means you don't want any advice, you want to go directly, make your own decisions, then you go through the direct plan. You will be automatically going through a direct plan where the unit value is on the higher side because no expenses have been deducted. But then you are driving your own car, you're taking your own decisions. So maybe in the beginning, I would always recommend go with a regular plan. Later in life, you want to think something on your own. If you feel better, you can go through a direct. But my recommendation always go through a regular plan because you will have the expertise of an advisor. You have the expertise of someone who's tracking your investments. And, that's always beneficial when you are not going to be able to spend full time on your investments, to that extent. And then once you have decided on the investment, then there is another option, which is a growth option or the dividend option. And I would recommend that since you are starting out in life, you would not require much income in the beginning. You want your money to be deployed in the markets so that your money can grow as much. And that's why you opt for the growth option always, when you're starting to make your investments. So now coming to modes of investing, and this is very important because this is here we are discussing strategy, how your money should be going through. And my recommendation is basically like when you're planning your goals, you will not have enough money in your hands to be able to put a lump sum amount and just go for and buy a gold, right? It's very difficult. You will be getting your salary income month on month. So it's advisable that you invest also on a monthly basis. And usually, because you're young, most of your investments are going to go to equity markets, and equity markets are volatile. And in volatile assets, it's best not to invest one time. So on one side, your income is coming on a monthly basis, and on the other side, you should be investing systematically in volatile asset classes. So if you marry all of this, what we get is nothing but a systematic investment plan. That is what you should be doing. And how it really works is very similar to a recurring deposit account, where every month your money goes out of a savings bank account and goes into a deposit account. Similarly, in the case of mutual funds, you decide there is a goal that you have, maybe 10 years down the line, and you have say 1,000 rupees to invest. Just a ballpark 1,000, very low amount, but I'm just for example's sake. Now you decide that okay, you want to put this monthly this money on a monthly basis on the 10th of every month. So you get into an arrangement with a mutual fund, and once you get formalize this, what will happen is on the 10th of every month, 1,000 rupees will be debited from your bank, and it will go into your mutual fund account, the scheme account, and get credited on that account at the value that exists at that point in time. So the value, the price of the mutual fund, the unit price could be on the higher side. So your 1,000 rupees will buy a lesser number of units. When the price is down, your 1,000 rupees will buy a higher number of units, which means you are buying less when markets are expensive. You're buying more when markets are cheap, which is a sensible thing to do. Unlike normal markets, normal people, when they're investing directly, they run after the stock market. When markets are going up, they try to chase it and buy stocks at a higher price. Or when markets are going down, they become scared, they become fearful, and they move away from the market when actually they should be buying. So like Warren Buffett says that buy when others are when others are fearful, and sell when others are greedy. So that's what you should be doing, and this is exactly what this particular systematic investment really does for you. So this gives you the advantage of rupee cost averaging benefit. So your prices, your cost gets averaged out. You're not becoming emotional about investments, right? Like the way if you were investing directly in the markets, you tend to become emotional. But this is like a no-brainer, very robotic. Every month, money is going into this particular account. It doesn't matter to you whether prices are high or low. So you're not timing the market. That's the best part of it. Now, the best part is if you are able to do this for a long term, then you get the benefit of compounding as well. So think about it. Let's look at this as an example. if you start investing 1,000 rupees starting the age of 25 years and invest all the way till 60 years, what will be the scenario at a 8% return per annum? I'm assuming an 8% return per annum. Remember, markets have given 13 to 14%, even 13% returns markets have given, but I'm assuming a small figure just to give you the effect. So for all those 35 years, 60 minus 25, 35 years, your total investment would be 4,20,000. What happens at the age when you turn 60? That 4,20,000 rupees will become 23 lakhs at 8% return per annum. Now, should you delay this investment by 10 years, which means you start investing at the time when you're 35 years of age and invest all the way till 60. So time is shortened out by 10 years. Total investment would be 3 lakh rupees. But what happens to your money at the end when you're 60? You get only 9.57 lakhs. Now just look at this. Had you invested 10 years earlier, you would have been richer by about 13.5 lakhs. So imagine how important time makes a difference. It's a small amount of money, isn't it? Which you could have easily invested 10 years earlier, but look at the effect. Look at the amount of money that you could have made had you invested earlier than invest later. And remember, this is just 8% we are talking about. Markets have given 13%, and it's only 1,000 rupees. Tomorrow, when you're earning a salary in big companies, you would have got investable surpluses of an excess of 50,000, 30,000, 50,000 rupees a month, which you can invest. Can you imagine the kind of money that you could have made if you start earlier at that point in time and build your investments up as your salary grows higher and higher? This is what compounding can really do for you, and it's like some say it's the eighth wonder of the world. So, how do you invest in mutual funds? You need to be KYC compliant. Very, very important. You need to be KYC compliant, and you can go to any mutual fund website, act as an investor, and just type in your PAN card number and your date of birth, and it will tell you your KYC status. If you're KYC verified, you can make the investments online, or take the help of the distributor or an agent who can help you assess your KYC situation and help you do your KYC. By giving these some proofs like Aadhaar card, PAN card, your photograph copy, your bank account details. And once all of this is done, which is done by the RTAs, the register and transfer agents, and you're KYC compliant, you can make investments online. So that's very, very important here. And everything is online now. Though physical forms are available to invest in mutual funds, but I would always recommend go through the online mode. And once your investment is done, your portfolio is made, you have a folio number, you can always log into the website of the mutual fund portfolio and see your portfolio details. And should you choose to withdraw a certain amount of money, you can redeem that amount of money, how much you need, and your money will be in your bank in about 4 days. You can also, if you're going through a distributor, you can also ask your distributor to initiate that redemption, and your distributor will initiate it, and you will get a message or an email to approve, and everything goes well, then your money will be in your bank in about 4 business days. What is NAV? Remember, I'm saying unit price all the time, but the technical term for this unit price of a mutual fund is the net asset value. NAV is in short, and this is basically the total value of the holdings of the mutual fund less the expenses. Expenses could be fund management charges, recurring charges, custodial charges, legal charges, accounting charges. Then in case for regular plan, commissions that are paid to distributors, all that is deducted. And after that deduction, whatever remains, when you divide it by the total number of units that have been issued to investors, that gives you the NAV. And this is publicly available information. You can go to the AMFI website, up there, or any mutual fund website, and see the unit price of the mutual fund. And every mutual fund has to be labeled for the kind of risk it is taking through a riskometer. You see on the left hand side a riskometer from low to very high risk. So wherever that needle is pointing indicates the level of risk that is entailed in the mutual fund scheme. That's the category of risk that this scheme belongs to. So obviously, if the needle on the lower side, you can very well know that this is a debt fund. And if this needle is pointing on the right side, the more right it gets, it becomes an equity fund. And if it's a concentrated equity fund, the risk is extremely high. So not that risk is bad. It's basically telling you how much risk is being taken so that investors are aware. Remember, risk is not bad. The higher the risk, the better the scope for the higher the scope to get a better return, in that sense. Lower the risk, the lower the return. Remember, investments which are comfortable are rarely profitable. So if you want to get out of your comfort zone, become uncomfortable, that will also help you get high returns, right? So that's risk factor. Remember, any investment that you're making, you must have a nominee in place, because in case something happens to you, God forbid, tomorrow, your nominee will be able to distribute the proceeds of the fund to the rightful beneficiaries, right? So nominee is extremely important in that sense, so always have a nominee while doing your investments. Okay. Because it'll have less paperwork and all of those factors that come later on in life. And in case there is a complaint that you have with the mutual fund, you can always write to the customer relationship officer, and they will help solve the issue. In case they are not able to solve the issue and not getting redressal to the complaint, it could be anything. It could be you're not got your funds on time, or investment has not been made, or there's some error in the name or the address that you have. So these are very small little complaints, and you can write to them or talk to them. And in case they don't respond, then you can go to Security and Exchange Board of India in that link below, scores.gov.in, because in a structured format you can register your complaint online, and SEBI is definitely going to help address those complaints, because they are like the principal of your college. Everyone is, that's the last place that you can go to, and SEBI is definitely going to take cognizance of your complaint and solve your issue. Okay, taxation on mutual funds here is basically, equity mutual funds are very tax friendly, because you have a 1 year is like short term, and more than 12 months is long term. And in case of short term capital gains, it's just 20% flat tax on gains. And in case of long term, you'll make only, you have to pay tax if your gains are above 1.25 lakhs, and the increment above 1.25 lakhs is taxed at the rate of 12.5%. So it's very user friendly in that sense. In case of debt mutual funds, the taxation is not, it's almost in line with the normal deposits fixed deposits that are there. It's almost in line, it's almost taxed to your tax bracket. But what it gives you is liquidity. That's one very big advantage that a debt fund gives you, which a normal fixed deposit will not give you. So that's all about the taxation part of it. And you see the taxation on other mutual funds schemes, because the hybrid nature, they are taxed accordingly based on the kind of proportion of assets they are holding. Okay, so that brings me the end of the session. And before I end, there's one saying from Warren Buffett that I would like to tell you. And it's like a warning that Warren Buffett really puts out, but it's a very realistic warning. And he says that if you don't find a way to make money while you sleep, you'll work till you die. So remember, it's very important to start investing, and you want to be able to make your wealth, want to be able to get to your goals earlier than usual. You don't have to work till 75, 80 or something, but you can get out much earlier than the rat race, because the only way you can do that is by investing judiciously in a disciplined, consistent, and committed fashion, so that you, in later on in life, you are able to make choices, because money gives you choices. Money in your hands gives you choices, so that you can live a life of freedom. You can live a life of choice, and not a life of compulsion. You are financially free. In a sense, you achieve financial freedom, and that's very, very important. Okay, and this is what was the very objective of this particular session. Thank you so much for listening to me. We'll open up the session for any questions that you may have. So if any one of you has a question, please unmute yourself, ask a question, or you can type it in the chat box, and I'll make an attempt to answer those questions. Thank you. Any questions, please unmute yourself and you can ask me, or type it in the chat box. Thank you.
Oh.
Any questions, you can, any student, you can unmute yourself, ask me a question. You can also alternatively type it in the chat box, and I'll answer those questions. Okay, so there's one question that has come up. It said, which platform is reliable to invest? I can't name a platform, WebHub, but I mean, I can't, because I'm not allowed to put any names to this. You can go to, if you are investing directly, you can go to any of the mutual fund websites to invest. There are also some mutual fund distributors and agents who offer these websites, who are there. They also, you can invest through them. But I would always recommend that, take some advice, go to a mutual fund distributor, go, firsthand, meet face to face, or through a call or something, rather to, and before you start making an investment, because that will be a platform where you're going to view everything. It's going to help you make those investments. So it all depends. There are quite a few of them out there, actually. I mean, there are brokers as well, but then you would want to the important part is to basically be able to have someone who you can trust in help giving you the right advice before you start making investments. So once you trust that person will automatically take you to the right platform. Hope that answers your question.
Okay.
Any other?
Thank you, sir. Thank you for your most wonderful session. So, dear Rahul sir, on behalf of Matrix School of Management Studies, we express our heartfelt gratitude for conducting an insightful and highly informative mutual fund investor awareness program for our students. We sincerely appreciate your time, effort, and expertise in making this program a great success. Your contribution has truly motivated our participants to understand the importance of early investing and responsible wealth creation. We look forward to your continued support in organization such meaningful and educational programs in the future. Once again, thank you for this sharing your knowledge and enriching our students with valuable financial insights.
Thank you so much for having me for this session and addressing your students. Thank you.
Dear students, please fill the feedback form and then leave for the session. Everyone. Please. Thank you, sir.
Thank you so much. So over to you, Kritika.
Thank you so much, sir, for this wonderful session. And I would like to thank to the college professor and the students who were patiently listening to the session. Now we can end the session. Thank you.
Thank you. Thank you for having me. Bye-bye.